Last week, we talked about the power of zero when it comes to the IUL. This week, the 3 secrets of high cash value life insurance. You don't want to miss these. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWealth Finance.
Now, before we jump into these 3 secrets, be sure to hit that like button. Subscribe if you haven't already. We are trying to get out a ton of good content for you every week. And we've been doing this now for over a year. This is episode 77. So if you appreciate it, hit that like button. On mobile, there's a hype out there that you can actually hype the video and spread it to more people. We definitely appreciate any help you get in spreading the word because we think everybody can take advantage of the information we're putting out here to save money and help grow their finances. Now, the 3 secrets of high cash value life insurance. Number 1 is the expenses inside of these things. In IUL, it's pretty transparent how the expenses work, but in whole life, it's not transparent at all. They're not required to disclose any of the expenses. So we're going to touch on both of these. 1, how the expenses work inside of whole life, and 2, how can we minimize the expenses, not just in whole life, but also inside of IUL. To kick it off, for the number 1 secret, let's start with how the expenses work in general in all of this life insurance.
Well, because whole life is a little bit less transparent, we can look at IUL and have an idea of some of these expenses when we're looking in a high IUL policy that has this requirement to disclose them because it is less guaranteed. So you'll have things like administrative fees, cost of insurance, various other elements that you can see inside of a whole life, in an IUL illustration. And really, in the end, whole life is going to have a lot of these same things inside of the policy as well.
Yeah, they basically work the same way internally to the insurance company. They don't really view IULs and whole life any different from an expense standpoint. It's the same risk. That death benefit is the same risk. How they treat the premiums and how they have to allocate those and set them aside for reserves and meet the guarantees, that's going to be a little bit different. But as far as the expenses, it's all insurance. Inside of whole life, they're going to treat the life insurance expense as what is the risk that the person is going to die that year. Well, in the IUL, we know that as annual renewable term insurance, where they're going to have a low cost at the early ages and it gets more expensive every year. But you don't see that inside of whole life because they don't have to disclose this. They just set aside the reserves and internally they're going to deduct a lower expense at the beginning of the policy. The bigger amount that they're actually withholding from the client is going to get set aside in reserves to cover the costs later on as it grows inside of their general fund. So there isn't a whole lot of difference in the expense part between those two.
Yeah, and I think that's one of the things that people who are strong on the whole life side will kind of say, because I don't know, I think because you don't actually get to see the expenses, it's like they don't exist for something. But a lot of this is why in the whole life side, you'll have that gross dividend rate that can get paid out, but it's not like you're getting that whole thing. It is going to have those expenses that are not disclosed, the same ones that we'll see in an IUL. And that is going to happen inside of a whole life policy so that you get what is that gross dividend minus those expenses.
Now, the guarantees inside whole life also require a higher amount of expenses inside of it so that the insurance company can set aside those funds to meet those later guarantees. But one way we can peek behind the curtain at the expenses inside of a whole life policy is how much liquidity does that policy generate in the early years? And if we look at the internal rates of return on these things, if you go 30, 40 years out and you look at that internal rate of return and you look at the assumed dividend rate, that gets you a window into what the average expense might be over those 30 years. And realize the cost of insurance is going up all the time inside of those things. That's why we don't ever want to just necessarily take 1 year, especially early on in the policy, but over many decades. And that's an easy way to compare whole life policies and get just a peek inside. What are they assuming for expenses inside this policy compared to this other policy?
So a couple of expenses where there's some overlap. In any whole life policy where you're going to use paid-up additions to have that, you're going to have some kind of fee attached to those paid-up additions, somewhere in that range of 5 to 10%, maybe slightly higher in some cases. And similarly, in IUL, you're going to have that premium load fee. And they're conceptually similar because a lot of what you pay in for paid up additions becomes cash value. And on the IUL side, it really is just, it becomes cash value minus that fee and other expenses in the policy as well.
Yeah, those fees are actually exactly the same in IUL and whole life. You put in a payment, they'll subtract out the load fee. The rest of it that's left over turns into cash value. It's just that in whole life, because it's a paid up addition, the death benefit is going to be some multiple of the cash value that it turns into. Whereas in the IUL, the cash value just goes up by whatever cash you put in minus the load fee.
When we optimize a design, we're looking to minimize one of those big early expenses. And that's the commission recapture that life insurance has to recoup those costs because they do pay out a commission. So when we optimize our designs, this is one of the best ways that you can actually minimize that. Your agents or agents have the power to minimize this by virtue of the tools that we have, like blending term and things like that, to minimize that commission cost.
Yeah, so as part of the expenses, the secret around expenses is with a proper high cash value design, we're going to minimize those expenses by reducing the commission, and we're not going to have too high of a death benefit compared to the amount of money they're putting in. Now, that's specific to a high cash value design. People don't necessarily have to buy life insurance for that. Sometimes they may be buying for a higher death benefit than they're going to fill up in mech space. But this is just one of the things that you need to know if you're trying to optimize those expenses for a high cash value design.
Yeah, and I think that that whole thing with the expenses that we just walked into goes into that next secret is, or what we walk through those expenses goes into the next secret, which is having liquidity. And high cash value life insurance in terms of assets that you can have is one of the best things for liquidity because you have so many tools that you can use to access those funds and really execute on any opportunities that you see fit.
Yeah, the top carriers that we tend to use, you can access 95 to 98% of the cash value, the cash surrender value inside the policy when you just borrow against it. We can borrow against it tax-free. And so having access to that liquidity allows you to just store your money in life insurance, a nice safe growth environment, and then deploy it when you're ready to go do other investments. So one of the secrets that surprisingly a lot of people don't know about high cash value life insurance is that liquidity, that they still have good access to it.
Yeah, and one of the reasons why people don't know about it is because there are so many bad designs that really, in the worst of them, you have zero liquidity in year one. And we really do not advocate for that. So if actually you could put in $25,000 of premium and have access to zero of that in year one, not good. When we optimize, we're looking for, and when you max fund, not everything's going to be that way, but if you optimize your design and max fund, somewhere in the high, maybe 80%, 90%, or even more is possible when you have an optimized design.
An all-base whole life policy will have no cash value for the first 2 years usually, which is really a drag on that liquidity, having access to it to go do other things. But I've seen some other policies where either in whole life you blend in some term insurance, or in an IUL where you just buy too much death benefit for the amount of money that you're funding, and there's no cash value for many, many years, not just 2. So people can really get hit with an illiquid policy with a bad design. Now, I have a good design on one of mine that I've minimum funded for the first 2 years, at the anniversary. I plan on adding to it during later on in that second year. But this is a $1.1 million IUL policy that I minimum funded. And I actually still had some cash available in the first year that I could borrow against because an optimized design met minimum surrender charges that I was able to get more than that into it despite just minimum funding. It's wild the difference in liquidity between an optimized design and one that is not optimized.
Yeah, and I think that's a really key factor too, is because when you do those optimized designs that are not putting so much of that commissionable insurance in place, then you can overcome some minimum funding years if you need to. But obviously, ideally, if you want that maximal liquidity, maximum funding is going to be there. And I talked about some of those early years when you do that optimized design and max fund, but it improves over time until you hit that break even point, and then you're just really, and that's a few years down the line, and it's just going to continue to grow from there, and that's where you're going to see those internal rates of return continue to grow and grow.
And this will bring us into secret number 3, which is high cash value life insurance as the financial keystone to an overall financial plan.
Yeah, I think this is what most people don't really think about when they think of high cash value life or just life insurance in general. Like I didn't it was totally out there. Like even though I paid attention, been investing, bought my first real estate in like 2008, like, bad time to do it, but and started getting to the stock market or a few years after that. So I've been investing for a long time, but it wasn't until I kind of stumbled upon some of the content creators in this space that I was like, oh wow, this is interesting. And they're not really talking about it in this way. And being that keystone, that foundational element, as I mentioned, with that liquidity, you can execute on bigger things, take some risks sometimes, calculated, and invest in things you might not have otherwise. Start that business. It can be that gigantic thing, but it also is just solid, even if you're doing normal savings.
Yeah, having high cash value life insurance as a home base to store our wealth, to keep our emergency fund, we get so many benefits from it, from tax deferred growth to tax free access to it via policy loans, tax free withdrawals up to our basis, the ability to use it as a volatility buffer in conjunction with our other investments, the tax-free death benefit that will pass on that includes all of the cash that we grow inside of it throughout our lifetime, that if we don't use it, passes on tax-free to our beneficiaries. Like there's so many things inside of this that make it that keystone financial tool that I have a hard time not seeing how this can benefit everybody's financial portfolio in some way.
And that's one key where a lot of folks in the traditional financial space, where they say this is a great tool for the ultra wealthy. And this is, I think they get that completely wrong because realistically, in some ways, you should put some focus on this before some of these other things, like if you put too much into a 401k, for example, when you are in a stage and phase where you think you might need to possibly draw from that, that can be a risky thing. And if you had diverted some of those funds into something like a whole life policy or an IUL where you can access and tap those things without penalty, obviously you can have a 401k loan, but if you have to go in excess of that for whatever reason in an emergency, that can be a dangerous thing. Penalties, a lot of different factors. So this can be a really secure thing for normal, regular people.
That's it. That's your 3 secrets to high cash value life insurance. Optimizing those expenses, understanding the expenses inside of them, the liquidity and access to the cash, and then using it as a financial keystone with an overall financial plan. Let us know what you think about that. Reach out to us on one of our YouTube channels. You can leave a comment on the video on YouTube. I think you can leave comments on Substack. So let us know what you think about that. Join us next week, and we're going to talk about why everyone is Googling life insurance for wealth and what they're getting wrong. My name is James Barber. I'm your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. We'll see you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.